Hey guys, welcome to another video. Finding a company with solid fundamentals and a stock with a decent value is your objective when you decide to try your hand at stock choosing, particularly if you want to hold on to an asset for some time. However, you should do extensive study on a company's business activities before investing in it in order to grasp its inherent worth and decide if it merits a place in your portfolio. So keep watching to find out how to choose stocks for long-term investing. Profits growth trends. Do the company's earnings typically rise over time? If so, it's a really good sign that the business is doing well. Positive signs might even include modest, ongoing progress over an extended period of time. But for a company to be worthwhile as an investment, profits, growth, and value must coexist. To determine if sales and profits are increasing or decreasing, you should review the company's financial reporting, which is accessible on the Investor Relations website. Positive profits growth is often a sign of a stable business environment. You should also be aware of the company's strategies for maintaining profits growth. A business that has a successful plan in place to boost sales, bring in new clients, and create new goods should be one to consider investing in. Company's competitive advantage. When investing, the industry may be a wonderful screener. To determine the development potential of a certain industry, start by examining how it is portrayed in the market. Looking at the company's position within the industry might be useful when choosing individual stocks. How does it compare to its rivals? Exactly what is its market share? Is there a feature that makes it distinctive? These important queries may assist in determining if a business has an advantage. Line up rivals with similar market capitalizations or size and analyze their profitability and stock performance over time to see how they compare to one another in a fair comparison. Debt-to-equity ratio within normal range for industry. Even some of the most lucrative businesses, like Amazon.com Inc., ticker AMZN, and Apple Inc. have debt, AAPL. Debt is a sign of the company's financial health for advisors. Be wary of businesses with high debt-to-equity ratios, a measure of a company's total debt in relation to market value. This ratio is used to identify businesses. Divide the total liabilities stated on the balance sheet and profit statement on the firm by the entire amount of shareholder equity to get this figure. According to specialists in the field, that figure ought to be 0.3 or less for investors with lesser risk appetites. However, there are several exceptions. Take a look at the debt-to-equity ratio for various sectors, for instance. Due to the dependence on debt financing in the IT and construction sectors, a greater percentage may be acceptable. However, if debt levels are too high, earnings can be under threat. Be sure the choice you make adheres to industry standards or has a convincing justification for why it does not. Price-earnings ratio as a valuation metric. A valuation indicator that demonstrates how effectively a stock's price represents the company's profits is the price-earning ratio, or P/E ratio. P/E ratio is one of the indicators used in fundamental analysis and value investing methods to determine if a company is undervalued or overpriced by the market. Divide the share price of the firm by its yearly profits per share, either from the previous year or projected for the next one, to get the P/E ratio. For instance, if a business shares are now selling at $40 each, and its annual profits per share were 2.50, its P/E ratio would be 16, which is lower than the typical P/E ratio for an S&P 500 company in May 2020. The ratio is a crucial metric for comparing businesses in the same area or industry. A company's market value is lower for one with a lower P/E ratio than for one with a higher ratio. Determine if the company merits that reduced value or whether the market is undervaluing it, which can make it a smart stock purchase, since it is your responsibility as an investor. How the business handles dividends. Particularly if the firm has grown its dividend distribution regularly every year for decades, a company that pays dividends is often one with some degree of stability. However, be wary of businesses with very high yields, which are determined by dividing a year's worth of dividends by the stock price. A corporation may be seeking to maintain or attract investors with that revenue stream if its dividend yield suddenly increases if it is in a desperate state. High dividends may sometimes be a sign that a business isn't making enough investments in itself or that its stock price is collapsing. In difficult economic circumstances, a firm may decide to temporarily or permanently reduce its dividend in order to increase liquidity. It's possible that the firm needs more money to cover current expenditures rather than that it's in danger. If a company expects decreased revenues or encounters short-term unforeseen costs, it may choose to reduce dividend payments. In this situation, it may keep the funds that it would have been issued as dividends and use them to meet other financial obligations. However, you may need to reconsider your stance if a short-term issue develops into a long-term one. Senior leadership's potency. Although it is more of a qualitative evaluation, a stock's valuation depends on how well run a firm is. How much do you believe a company's executives? Strong organizational culture that is balanced with innovation and flexibility is promoted by effective leadership. Businesses that reinvest their revenues in themselves expand their operations and solidify their positions in the sector. A well-managed business often experiences rising stock values throughout time and in a variety of economic climates. It might be useful to consider a company's leadership tenure with the organization, the kind of experience they provide, and how it translates into adding value to the business when assessing its effectiveness. Investors may learn more about how a company's management interacts with its shareholders by reading the transcripts of CEO speeches or by listening to quarterly earnings calls. We've reached the conclusion of this video. Let us know what you think in the comments area below. Give this video a big thumbs up if you enjoyed it. Also, don't forget to subscribe to our channel and turn on the notification bell so you don't miss any of our forthcoming videos. Thank you for taking the time to watch. Take care till the next video, and good luck.